Bega Cheese is a big Australian company. They make lots of dairy products that you've probably come across before. It's a public company, so what that means is its shares are on the Australian Stock Exchange. And as you can see by the article, it's just become our latest $1 billion company. But I think what's interesting to note from a Year 12 accounting perspective is, what does that mean? What's worth $1 billion specifically? So let's look at the balance sheet. Does it mean that they have, or we look at the balance sheet as assets equals liabilities plus owner's equity, following our accounting equation? Does it mean that they have $1 billion of assets? It actually doesn't. They might already have more than that. They might have less than that. That's actually irrelevant to whether it's a $1 billion company. Does it mean they have $1 billion in liabilities? Well, no. That wouldn't be something that you'd be celebrating, obviously. We want to have few liabilities, so it doesn't have anything to do with that. Does it mean it has $1 billion in owner's equity? So assets less liabilities will equal owner's equity, and if we total that up, and that's $1 billion, does that mean we're a $1 billion company? It actually doesn't. Does it mean we have $1 billion of cash in the bank? That seems to be a little closer to the mark, because cash can be spent and cash is ours. We can do whatever we want with it. But again, it actually doesn't mean that either. So the balance sheet doesn't really provide us any clues. So let's go and look at the income statement. Are we a $1 billion company if we have $1 billion in revenue? So we add up our cash sales, we add up our credit sales, and that equals 1,000 million or $1 billion? And the answer is no. Does it mean we've made $1 billion in profit this year, pure net profit? And again, the answer is no, it doesn't. We might make more than that, we might make less than that, we actually might make a loss, and we can still be a $1 billion company. So we're not going to get the answer from the income statement either. So the way to think about a $1 billion company, or how much a company is worth, is to look at its shares. So when a company is floated or listed on the stock exchange, it's divided into shares. What happens then is, then the public can choose to buy a share in the company, and then you will own a very small part of the actual company. So Bega shares are on the stock exchange. We can jump on to, say, NabTrade or ComSec and go and buy shares in that company right away. And basically, when a company puts itself on the share market, it chooses how many shares to break itself into. So if we broke ourselves into 2 shares, we'd split it in half. 4 shares, we could do that. We could do 8 shares. We could do 500 shares. So that seems like a lot, but big companies on the share market have millions of shares. So 500's an example, but it's not a realistic example, but it's going to demonstrate the point that when we actually put our shares on the stock market the first time, we get to choose the amount. And we can choose $1,000 per share if we like, but then no one's probably going to buy them. We could choose 1 cent for our shares, but then maybe too many people will buy them. That's not a realistic amount. So let's say, for example, when we listed our company, we said these shares will be valued at $1 each. So we've got 500 shares, and when we listed our company, we said it was valued at $1 per share. So what's the total value of this company? Well, it's equal to the number of shares, which is 500, times by the share price, which we valued at $1. And that is a total value of $500. So what we actually call that is its value, but the word we use in business is that is its market capitalization. So when we say Bega is a $1 billion company, this is the number we're talking about, its market capitalization. So each investor then, so once the shares are on the stock exchange, you choose how many shares to buy. So for example, someone might have bought 5 shares. So you've owned 5 shares out of 500, so a very small percentage of the company. And then what happens is, once they're on the stock exchange, the value of those shares goes up and down as people buy and sell them. So if those shares went up to $1.20 each, you would have made a 20-cent profit on all 5 shares. That means you've made a total profit of $1. We don't always get that lucky though. Maybe the value of the shares goes down to 75 cents. Well, you've lost 25 cents on each share. You've got 5 shares. That equals a loss of $1.25. And that's fundamentally how the stock market works. We're buying something at a value that we believe is its true value or market capitalization. And then the market goes up and down every day and we try and make a profit, but sometimes we make a loss. So So let's go back to Bega Cheese. When Bega Cheese divided itself up into little pieces, it divided itself into roughly 133 million shares. So we said big companies are divided not into 500 but absolutely millions, even hundreds of millions of shares. And there's about 133 million shares in Bega Cheese, a little bit more than that actually, but to round it out, it's 133 million. So when the company first put itself on the stock exchange in 2011, it valued its shares at $2 each. So what that meant was there were 133 million shares at a share price of $2 each. That would have been a total value or market capitalization of $266 million. So that is not a billion-dollar company. It's simply, if you add up its total number of shares times by the share price, it doesn't equal $1 billion. So what's happened? Well, in the 4 years since, because the company's done so well, the value of each share is now $7.50 each. So what that means is we've got 133 million shares times by $7.50. Now that is 1,000 million or $1 billion. So what we say is the company has a total market capitalization of $1 billion. So interesting to note that that is not a topic that is in Year 12 accounting. We don't deal with market capitalization. It's a really good figure to know. But the important thing to realize is that when you read the news and you see a company's worth, say Apple's worth 100 billion, or BHP's gone down to 80 billion, something like that, it's not the value of its assets, it's not the value of its owner's equity, it's not its sales, it's not its profit. All it is its total market capitalization.